So the first question is actually relevant to me, though I didn't ask it. Someone said, I want to start investment accounts for my kids. What options are there, and what should I be thinking about?
Great question.
Well, so when it comes to saving for kids, it really depends on what do you want to save that money for? What is the money going to do for the child? If the answer is I want to pay for their college, then the solutions are very simple. A 529 plan or a Coverdale education account. A 529 plan is nationwide, but they're sponsored by individual states. So every state has their own plan. You can live in any state and use any other state's plan. So I can live in Pennsylvania and use Virginia's plan, which happens to be my favorite plan. Or vice versa, you can do, whatever you want to do. Now, there may be limitations about the benefits you receive by using a non-state plan for the state that you live in. So if you live in New Jersey, you might get a benefit if you use New Jersey's plan. Actually, I don't think New Jersey offers any benefits. I looked into that.
Typical New Jersey.
Yeah, they're communist. So I think Illinois is a better example. Illinois, if you live in Illinois, you use their Illinois plan, you get an Illinois state tax deduction up to a certain amount. But if you use Ohio's plan or Delaware's plan, you get no benefit. In Pennsylvania, it's a pretty great state. You can use Pennsylvania's plan, get a Pennsylvania income tax deduction. You can use Virginia's plan or Delaware's plan or Hawaii's plan and get a income tax deduction in the state of Pennsylvania. It's one of the more generous states with regard to 529 benefits.
Don't go saying Hawaii, because then a lot of kids will say, listen to the Stewardology podcast. I can go to Hawaii and go to school, Mom and Dad.
Yes, which is a great point and a great segue to another valuable benefit of a 529. Where you live has no impact on the availability of the plan you use, and the plan you use has no influence or requirements on the state in which you must go to college. So you can live in Pennsylvania, use Virginia's plan, and go to school in Florida or Tennessee. That's not a problem. So don't worry about the state. The state is not relevant unless your state has an income tax deduction that you might miss out on. The state you use doesn't really have an influence on where you live or on what state your kid wants to go to school in. There are a couple exceptions. Prepaid tuition plans for a particular state only applies to in-state tuition for state-run schools. Okay, so those are 529s. Coverdales work similarly. You can't contribute as much to a Coverdale, but they offer benefits where the money can grow tax-free if used for qualified education expenses. 529s, you can contribute more. The money may have a state income tax deduction, but no federal income tax deduction. So you're not reducing your federal taxes, but the growth is tax-free if used for appropriate college expenses, college-related expenses.
Can one have both?
Of course, yeah. There's no
So
problem.
you can do both 529
529
and Coverdale if you so chose.
Sure. The benefit of the 529 is that it can be listed as the parent as the owner, not the child. The child's listed as the beneficiary. Mm-hmm. And you can change the beneficiary if your child decides not to go to school and their younger sibling does. You can just switch the beneficiary of that 529 to the younger sibling or to a niece or nephew, or you could use it for yourself.
I remember when they first started out with the 529s, right when my kids were born, that was not available. Yeah. It was locked to the kid, if I remember, which was not a positive piece at that time. And I'm glad they've made those changes.
So that's an option. Another option. So you tell me, I don't care about school. I don't want to limit my kid to only use the money for education. By the way, if they don't use it for school and they take it out for non-college related expenses, there is a 10% penalty and the growth is taxed as income.
Ouchers.
Okay. So there are some negatives here. If you want to avoid that and give them the most amount of flexibility, you can use an UTMA or UGMA account. That's a Uniform Transfer to Minors Act or Uniform Gift to Minors Act. Don't worry about the letters. It doesn't really matter that terribly much. All it means is that it's a custodial account. The parents manage it on behalf of the child. It is the child's money, must be used for the child's benefit. Any capital gains and dividends are taxed as ordinary income for the child. And there are a couple other tax nuances that you would need to be aware of, things like kiddie tax, but don't generally apply unless you're doing substantial gifting into these. And when it comes to college, it's a child's asset, which gets counted more negatively when it comes to the calculation for financial aid eligibility. So there are some nuances there. The benefits is that you can use the money for anything. There are no penalties. You just have to pay taxes along the way.
We actually had the UGMA for my kids, and I agree. Everything you said, 100% true, and even to the point of being liable for the taxes. When my son was 11 years old, we had such growth in his portfolio that we had to pull money out of his account to pay for his taxes for that year. He was 11 years old.
Go figure.
He was killing it. He was
gotta be tough to have that trust fund, man. That trust fund money.
Well, I think it's all gone. He spent it all in school and other things.
I'm teasing you. The third category would be, hey, I don't care about college. I don't really want him to use it for like buying a car or a house. What I really want is I want to start paying or saving for retirement, because I heard about this compound interest. And if I start them super, super young, I put a little in, it grows to like an exorbitant amount by the time they get to retirement. So I want to fund a Roth IRA. They're 3 years old. Can I do that? Answer is, generally, no, unless they have earned income. So how does your child get earned income? They have to do work, have to provide labor. So you can contribute up to the lesser of how much they made for that entire year in wages, or $7,000. The lesser of those two numbers. So the child would have had to have made more than $7,000 for you to contribute at least $7,000 to the account. In this case, the money is put in the Roth IRA, grows tax-free. You can touch the principal, but you have to leave the growth until the child reaches retirement. Ideally, you would just leave the whole thing there, not touch any of it, and allow compounding to work its magic.
So just a reminder, make sure that you consult with a financial advisor if you're thinking about doing these things. If you'd like to do that with us, you can go to stewardologypodcast.com/review, and we can do a stewardship review there with you.
Yeah.